Hello guys, glad to have you on board again. Today we are Wednesday, so this is about time for us to trigger the educational content videos. I remind you that I stopped the daily updates regarding market updates and trading scenarios and whatever, at least until further notice. I'm still waiting for Wall Street to return to normal behavior, at least give us a glimpse of tradable information, because what we're having right now, and I stand on this, every fucking beginner must stay away of the market until further notice, and especially whatever that is that might be correlated to US stock market. So you can't trade the stock market anymore. You can't trade the major forex, because everything that is dollar stamped will have a problem until we figured out what we deal with in the nearby area. This is a really important warning. No beginners in trading anymore, at least anything that is related to stock market, especially in the US, or anything that is dollar related. Experienced traders, you can still get your hands down this dangerous road, but I hope you do understand how tricky that is. Though lower the position sizing, be aware that volatility might be down the corner, both to the upside and the downside. So it's just tricky market as hell. All right, so that's the reason why I'm stepping down. Not necessarily for me. I mean, I personally, they washed me out. So I'm exhausted, and I really need to take a little bit of distance to just recalibrate. All right, call it that way. All right, if you thought 1 second that it would be stop trading, you really don't get it. I'm never gonna stop trading. It's just I can't have a clear mindset at the moment, and when the vision gets blurred is the moment you want to step back for a little while. So I'm stepping back in order to have a clear mind for many reasons. Like I said, I'm personally exhausted, but more than anything else, the market contraction we have recently is really signifying that something ugly is down the corner. I wish it could be to the downside, but I mean, market can do whatever the fuck it wants. So I'm not here to impose my vision to the market. Just I see something, I see risks, and I see prices moving up in a very contracted volatility. I don't like that. This is a price squeezing structure going on. Can only end with volatility bursting, and it can only be leading to volatile outbursts. Like we can take 2% in a day and lose 4% the day right after. It's just trappy as hell. So it's untechnical. It's everything needed to end up with a disaster if you're not well prepared for this. And most of you guys, let me tell you, are not really prepared for that. Reason why I really like to step down for many reasons. Like I said, personal reasons, and I don't want to talk about those markets because I know some of you guys just can't resist trading difficult context, no matter the warnings I can be saying that this is for professionals only and stuff like that. Some people just follow me, so I do it both for me and for you, all right? Though anyway, today we're going to use the S&P as an background thing to teach you something. This is educational content, all right? So no trading scenarios and stuff like that, just technical stuff. And today, not submitted to vote into Discord, is a topic and a question I had coming over pretty significant numbers of times last week, especially last week. And that's a question I have dealt with in the past, but not in a sufficient way. So we're going to do it again, and hopefully do it better, because now I think I've got a much better understanding of what the problematics are. So let's get straight to the point. What we're going to be doing today is a question, recurring question I get in here. Phil, how do we do if we want to learn your strategy and risk management purposes and stuff like that if we don't have the indicators? Just like I said, the indicators is just like a dictionary. Like it is using my automated tool or semi-automated tool to learn the strategy with me. I mean, like I said, to me, it's easier to communicate with you if you use my tool. Though I'm using those tools as a way to ease communication between you and me. But yeah, I do totally understand, and I always stand for this loud and clear. The indicators are optional. This is not necessary. You don't have to take those indicators to learn my strategy. But yes, obviously, I do use those indicators personally, so it's easier for me to teach you with them. That's the thing, all right? So some people have been not necessarily complaining, but saying, Phil, would be nice if you would explain with a little bit more details, how can we use the strategy without the indicators? So most of the problems surrounding the technical part analysis, because remember that the strategy, and I stand on this, if you don't understand what I'm saying it right now, then you really need to stop that video, have a look at the PDF manual of the core elements of my strategy. I assume whoever's looking at that video right now knows about my strategy core basics. What type of indications I'm using, how they all orchestrate together in a logical manner and stuff like that. And I'm not going to go down this road in here. So you have a price analysis type of signal algorithm that is basically taking care of the two core questions of a strategy, absolutely necessary to every strategy out there, contextualizing what type of market you do, because if you do have a price filter that is just basically saying, all right, sell in here, buy in here, I mean, fuck no, it's not worth it. It's certainly not going to work. So at least the core basics needs to be switching strategies between trending context and ranging context. That's bare minimum. Myself, I teach you some other intermediate contexts like the trending ranges and also the market excesses. These ones are a little bit more tricky to figure out without the indicators, but we'll try doing it anyway. It's giving you clues that you can use reliable information. Remember that the goal in here is that what you need to understand is the pros and cons of technical indications, meaning algorithms and automated stuff. Like when you use framework, it's basically an algorithm that is doing something for you. All right. So now let's assume what are the pros and cons. All right? The pros of an algorithm: it doesn't make mistakes. The algorithm does what it's been meant to be doing, and it doesn't go on any different path. It just follows the goddamn rules it's been taught to achieve. So the pros of algorithmic assistance is consistency, all right, no errors. But the problem is indicators and automated algorithmic decisions. The problem is in here, in the decision-making process. I told you that trading, and especially risk managing, is all about shaded gray areas, subjective stuff that you get to learn through experience, but how do you think you can teach that to an algorithm? Though that's doable, possible in some way, but certainly not going to be perfect. So the problem and the cons of technical algorithmic indication is that the subjective part of trading can hardly be taught to an algorithm. Let's consider a 0 to 10 scale of subjectivity, right? If you increase from level 1 to level 2, let's say it's going to take 10 code lines to teach the indicator a little bit of subjective analysis. Now, if you want to go from 3 to 4, it's going to require like 100 code lines, like way more than the 10 you use to switch from 1 to 2. So it's more like a parabolic increasing curve. If you want to teach subjectivity to an algorithm, it's going to require a shit ton of work. And there is a limitation that at some point, more code lines doesn't necessarily really improve the algorithmic decision-making process. This is why I still tend to believe that for retail traders, automated trading is a bullshit idea, because you're never going to get enough subjectivity to be profitable. You cannot teach trading to an algorithm. But you can use it to assist on recurring tasks in which it will be better than you because it'll make no mistake. That's the core thing. Use the algorithm to destroy subjectivity, to reduce subjectivity and avoid personal biases and errors. All right. So if you want to reduce, if you don't want to use my algorithms, this is what you're going to lose. The only thing you're going to lose is you're going to have to learn to destroy subjectivity all by yourself. All right. So this is what I'm going to be teaching you today. How to use reliable technical information to reduce subjectivity inducing into the decision-making process. It's still going to be subjective at some point, which means there is room for error. So you're probably going to make a little bit more errors. But remember that anyway, the algorithm is going to do some errors as well. The algorithm will not make mistakes on calculation, but it will do mistakes on some specific context in which I personally would have done something different for subjective reasons that I wasn't able to teach the algorithm to detect. All right? because there is a limitation. Can't be perfect. At some point, the algorithms will do something I wouldn't do personally. So they won't react the way I would do, because I will add some layers of personal subjectivity, some context I can't teach to the algorithms and stuff like that. All right? So it's always pros and cons, always balance stuff. Be aware of what you're adding with an indicator, what you're losing when you remove it, and how to compensate the thing. So without indicator, you can use the same old rules, the strategy. I teach you the strategy, the same organization through it, but you're going to lose, and you're going to lose one thing. You're going to just add a little bit of subjectivity, and you're going to have to dampen this, because subjective analysis when you're beginning is just the worst thing for you. It's going to bring up doubts, it's going to bring up things like that, and those things are really triggering emotional reactions and stuff like that. So for beginners, fight against uncertainty is the top one priority. So how do we destroy subjectivity as framework usage? So remember, framework is just trying to emulate trend channel plotting. I've already been telling a lot about that. So today I'm going to explain how you can build those trend channels and context channels on your own, all right, with as much as possible reduced subjective decisions. All right, so what we're going to do first is I'm going to delete framework, and I'm going to start with a blank chart. So don't forget about those things. All right, I'm not going to delete them. I'm just going to let them. What the fuck is that? This is not useful. This one neither. And this is our previous historical high. This one I'll keep it. So let's do the job. Let's go, for example, in the 1 hour context, and I'm going to try giving you some rules. So first of all right, you're going to use a moving average. I think that's the easiest way for you, because remember that the core rule is that if you want to build a channel, you need to figure out what the price is doing right now. All right, what is the recent price action direction? Are we going up or are we going down? But the problem is, this question is subjective all by itself. So if I tell you, all right, do you think the price is moving up or down? Some people will say up, some people will say down, but how do we set a ground rule in here for everyone? Something that you just have to answer by yes or no, and everyone has to give the same answer, right? Non-subjective, non-personal decisions. So let's use the moving average. Like I said, could be better, could be worse. We're just going to use something rational in here. So use the moving average 50 period. So let's put a moving average for 50 bars. All right. So basic rule. Price below moving average and negative moving average. All right, so the moving average going down and price is going down and being below and breaking the previous swings. All right, like we have a swing in here, we go in below. So okay, lower lows, lower highs, negative moving average, and price below it. This is exactly the definition for a price moving down. So when price moves down, you're going to build a trend channel out of the latest two resistance and the in-between support. All right. Call it that way. So now we've got a second level of subjectivity. What the hell are the two latest resistance? What do I use as the two latest resistance and the in-between support? So do I build my previous resistance in here, or is this one? Because this is going to be, once again, subjectivity layer. In here, if I tell you take the last two resistance and build it with the intermediate support, some people will draw the trend channel with those two tops. Some others will maybe this one, or this one. So subjective analysis, many people giving different answers, not possible. We need to reduce as much as possible the subjective analysis. So I'm going to give you a rule. So it's been tough because, once again, I wish we could have some good indicators in here, but not necessarily. A lot of shitty coders out there in TradingView. But anyway, I try to get with the best possible thing with free tools. God damn it, I don't remember this one. Which one I've been using? I think it's CryptoVN. Yeah. So it's certainly not as good as my personal sine wave. I've been customizing it a lot, obviously. So not to sell my stuff, all right? Just saying, in here we're going to do it totally free and convenient enough and good enough for you to be trading with these things, using my strategy with free options. All right, so let's forget about momentum. I'm just not going to hide it. All right, use this thing, right? As a cyclical indication, it's a free tool available for everyone. You can use this one, all right? So the thing is, how you're going to remove subjective analysis. Remember one thing, when I'm building the trend channel, I'm using the trend time frame, which is normally the higher time frame. So if you're 1 hour, the trend time frame is 4 hours. Remember that you've got the table. I put you a timetable right into the PDF manual, right? So use it. The higher time frame is 4 hours, and the upper, which is the context time frame, will be daily. So what we do is that you'll switch 4 hours, and you have a look at cycles, all right? So what you have in here is you're going to be using these things. So in here is your last resistance during that oscillation period, and the previous one is the previous cycle. So where you will build your channel in here is from there to there, all right? So this area and this area, all right? We need to build a trend channel. As the price moves down, we're going to build it from those two tops to the in-between to the in-between support. So let's get back to our major time frame, to our local time frame, and let's build the fucking channel. All right, take the channel tool. So we know that we're going to build those two resistances. So let's pick the first one, the second one, and go to the widest possible channel. All right, so problem in here, we're going to have to adjust. All right, we need to adjust. Every week must be fitting in. No problem. If you extend this week, goddammit. All right, this week is pulling off, so no way. We're going to build out of there. All right, so this is where we build out of the two resistances and then the two supports. So this is where your trend channel is. Price is moving down, and you take the higher time frame cycles to plot to define the two resistance location. All right, so here is your trend channel. All right, now how do you do with the context channel? All right, so the context channel is two levels of two time frames above. So in here you're in a bullish oscillation, prices are fairly moving up. All right, in here the moving average is bullish and whatever. So in here you're still moving up. All right, so how do you do in this case? You're going to take the latest two bottoms and the in-between resistance to build a trend channel. So in here, your trend channel will be used this way. Sorry, the support is in here. All right, so this is where what I don't really like about this sine wave. But anyway, let's apply the goddamn rules without subjective analysis. This is what we'll do. All right. The bottom of this cycle and this one with the intermediate resistance in between. Remember that the resistance must always be in between the two dots in here. Cannot be afterwards or whatever, right? You pick the highest point in between. So that will be it. The trend channel and our context channel. All right, in here there is a very, very dangerous scaling effect, as we do have a very narrow trend channel compared to the context we deal with. All right. But you've done something similar to what I'm trying to teach Pro Framework to do. All right, you've been putting a context, which is a larger way of analyzing, with a short-term way of analyzing what prices are doing. So in the short term, we were bullish, and now we're losing strength. All right, we're just breaking out of a bullish trend channel. Certainly not bearish. I mean, breaking out of a bullish trend channel certainly doesn't mean bearish. Simply means losing steam. All right. And we're dealing with the top area of a trend channel. So bullish trend channel, top area, so pretty much a resistance area. Okay, now I'm going to teach you one more thing. Remember that if you use framework, you'll figure out that framework has a different way of doing things. The trend channel is a line, step line, all right? The context channel is an area, all right? It's a ribbon at some point. So if you want to emulate this, like trying to replicate, what you're going to be doing is, instead of using trend channel, you're going to be using this tool, which is the Fibonacci channel. All right, I'm just going to build an example in here and give you the details. So you can copy this, all right? Copy as well the transparency purposes. It is for coloring purposes, all right? So it's just a trick I'm using. With the transparency, I can build some intermediate levels and correlation like that. Just copy paste those things, all right? So as you get to use this one, all right? You're going to do the same thing. Use the trend channel as a basic channel, all right, lines, And when you get to use context, I recommend you use the Fibonacci channel instead with the settings I just gave you, and instead you'll get the same ribbon. So you've got a pure manual copy of framework. All right? So in here, I personally think that those cycles are bullshit, though I would be building in here. All right? Subjective analysis. But anyway, if you build it in here, it's no big deal. And you've got your context. On a 1 hour chart, the big major context is this ugly trend channel, bullish trend channel, and we're in the resistant context. So in the tradable speculative area, so you are in a bullish context. What is this context? All right, let's zoom out. All right, this context is though a bullish range. All right, and it's mature. So any fucking way, you're a beginner, you know you don't trade the 4th range boundary, so you don't give a shit about what we're doing here. If you're a beginner, you certainly don't speculate in this area. It's for experienced traders only who can deal with mature range contexts. So we can try to figure out a reversal, but anyway, it's a bullish range. So bullish ranges are the most complex stuff to deal with to trade bearish reversal onto, because we can just grind our way up as long as we want in this area. We can obviously be at risk of a bullish breakout. That's the reason why we get to the conclusion I warned you about on the earliest words in this podcast. I told you this is a real dangerous context for beginners. You certainly don't want to get your hands in this thing, and even for experienced traders, it is not without risk-taking, because we are at risk for a bullish breakout, and we're also at risk for just a bullish, non-volatile at burst, in which we just die out here for as long as necessary. That's exactly what we're experiencing at the moment. Very low volatility, and I hope this area will be resistant. And if it's not, then there is a risk for a huge breakout. Okay? So that's what we're dealing with right now. And you manage to have the same conclusion and I do have without my tools. So that's exactly what we wanted to demonstrate. You can use my strategy without my tools. It's just a little bit more subjective, and you have to remove those subjective points in order to be effective. How can you do this? Use the 50 moving average to decide which price direction we're currently having. And regarding the context analysis, you go 2 types above, you go 2 time frames above, and you use that Fibonacci trend channel. All right? Now we need to answer very important questions. How do we contextualize with these things? I taught you a set of rules into the PDF manual, obviously with my tools, but you can use the same things without. There's just going to be a slight difference. When it is range context, it's pretty much going to be the same thing, all right? Which means you speculate in the range area, you're going to try catching the movements when the price breaks out of this trend channel. When you're trying to use trend context, this is where things will be a little bit more tricky, all right? Because when you get to trending context, my algorithms will be and have been built to behave differently into trending context and ranging context, all right? The algorithmic decisions are altering the way indicators plot the resistance and support. They're not building trend lines, all right? What I do is instead, if you're figuring this out, all right, the trend channel in here, the context channel in here will pretty much do something like that. It will go there, and it will dampen, all right? It will try following prices. Though the thing is that the algorithm has a parabolic reduction system, which means I'm reducing amplitude on the resistance to force the trend channel to, instead of behaving this way, to behave this way. All right? So they get to compress, all right? Though that's not necessarily how they work. It's pretty much like this one is going to be linear, or a little bit, just a little factor, acceleration factor, but the resistance factor will increase significantly, to the point that the two can only converge through time. So they cannot be infinite trend channel with my indicators, but they can be in time. Like, theoretically speaking, the price can do this an infinite number of times and remain forever in this channel. The reality is obviously it never happens, but theoretically it can happen, but it won't be possible with my tools because of the acceleration factor. All right? Though this is just technical specifications in here, but there will be differences. So when it comes to trend, in identifying the trend context with those things will be subjective, but I'm going to try giving you some rules. So how do you figure out trends and range? When you're dealing with the context trend channel, I mean, this is likely a range. So in here, it's just a bullish range we're dealing with, certainly no trend. If there is such thing, then the trend will emerge by breaking out of this. So first question has been answered. How do you figure out the breakout context with those things without my tools? Then you must be breaking both the trend channel and the context channel. So which means if you want to break out, this is where it occurs. If we keep on going with the SPX, this is where the breakout area will trigger itself. Okay, this is why I told you there is a risk for a breakout in the nearby area. Okay, so when you're in breakout context, let's just try to zoom back in prices and figure out a breakout area. All right, here is where I'm going to have to scroll fucking back in time. All right, let's get to a trending context. In here would be, so let's use the Fibonacci thing. All right, let's assume we had one in there. All right, well, I go easy, all right, I just save us some time. So this is where the breakout truly occurred. Then you've got a breakout in here, market is pulling back and keep on accelerating. So as you'll see that your trend channels in here will likely be bought in there, all right? So you're going to have one trend channel in here. Let's assume another trend channel in there, whatever, right? This is the multiple trend channels you'll have at multiple maturity stages. When the trend channel is built out of the context channel, means you're in a fucking trending context, all right? The maturity of this thing will depend on what you'll see. The divergence generally occurs when the trend channel, after bursting out of the context channel, is slowing down, all right? So typically, in here, you would have had this trend channel, you break it to the downside, but still bullish oriented. This is where I think the divergence stat would set itself. All right, when the market is slowing its pace or building its pullback. All right, this is basically when you'll have ranging context, when the trend channel in here are moving up and down, but you're still far marginally above the resistant context. When you have this might be your pullback. The final excess is when you'll try accelerating afterwards. I don't know if that's clear, but let me give you an example. So in terms of context, in here, consider that you've made your 23% retracement. This could be a potential pullback. Remember the rules for a final excess. Final excess must make new highs and break 3 trend channels. All right, try to accelerate. Normally I teach you breaking out of context, but remember that my contexts have a reducing factor, a compression factor, that you won't have because the trend channel will be, the context channel will be bought this way. Right? So the rule I give you in the PDF manual, trade the resistant context as a final excess, won't be possible with trend channel, because which will be your resistant context with the pro indicators, with the pro channels, is certainly not going to be the case with manually plotted channel, because your top channel in here will be far higher. All right? So in order to compensate in here, you're going to change the rule. All the rules are the same except for the final excess when you're using trend channels. With using trend channels instead of pro channels, what you're going to be doing is waiting for new market top, and the market must break above a trend channel. All right. So you use your trend channel for, I'm just going to use this tool to do it manually, all right? You would have had one trend channel in here. You're breaking above it. This is where you got your final excesses context. Obviously in here it didn't work out. Good old SPX 500. But anyway, this is how you would have highlighted this potential reversal area. All right, remember that reversals is anyway for experienced traders only. Beginners, you certainly don't do this. All right. So in here, we would still be in a trending context. So when people tell me U.S. stock market is trending, I'm saying, no, we're not. Some people feel like there is a trending sentiment, which is totally different. In a technical perspective, we're still in ranging context, at least in those 1 hour to 4 hour chart contexts. All right? So that being said, I hope you understand how you can do without the indicators. It also introduced a little bit more risk, because instead of trusting things I've been making for you, like these are indicators I can back up because I've built the indicator, I know they work, so I can say, all right, you go to use those things. So this is what you lose without the indicators, but still, that certainly isn't the end. You can do without them without problem. Just make sure you limit the risk of subjective analysis when your decision-making process. In order to do so, you can use the 50 moving average, just like I said, use the free sine wave we just highlighted, or whichever other sine wave if you have other preferences. Just make sure you replace irrational and personal decision that can be biased with rational set of rules. This is how you get better at trading. The final and the big problem in here is that you're going to have to learn a set of rules to define the context. I gave you an easy way to do it when your trend channels and the prices are evolving above the context the context channel, means you're likely in a trending context. All right? Though there are pros and cons using my tools or not using my tools. Like I said, they have a cost. If you can't afford them, just please fucking don't pay for them. That's simple as that. These can't be free because it's years of development, and I've been putting a shit tons of effort in there, and I think giving it for free is just nonsense. So this is how it goes. You want them. It's an easy thing that makes things a little bit easier for you to work on what's essential, risk managing. If you can't do this, then you're going to have to add a little tiny layer of personal work in there, in which you're going to have to build yourself the set of rules to answer the two real fucking questions that a technical analysis must perform. What is the context? And are we dealing with an interesting speculative area? All right? You can do those things without my tools without problems. Still, this is not the end of it. Remember that there is a real important part, which is risk management. All right? Highlighting the context and highlighting the speculative areas is one part of the job. You still need a momentum indicator, likely with a cyclical indicator on top of it, and you need to highlight risk managing patterns, which means no black or white. It's not okay, sell, okay, buy, but patterns. Build yourself a set of patterns. This is where the most complicated stuff is, because in here I've got no option. I can just tell you what my patterns are, and that means that would be stupid. I mean, that would give you intellectual property like that. So I'm not going to be doing this. So in here you got to put your own sweat and put your hands on the dirt. Though, learn some patterns. This is not really complicated. You can use your own patterns on the momentum, learn them, but you need to have a complex way of risk managing. At least 3 or 4 layers. No, don't go just black or white. Be a little bit more, go a little bit further than that. Have low risk patterns and high risk patterns. That gives you 4 set of answers, and you really need to have this. This is another problematic. We'll eventually make a second video about just momentum in the future. But what you need to be doing, right? I told you what to do with to replace framework. In order to replace momentum, what you need to do is have a momentum signal. All right. I strictly recommend momentum plus cycles. You do whatever you want, but that's a really strong combination and definitely the strongest I've ever seen. So make sure that you have at least 4 sets of signals. All right. Don't go blue arrow means buy, red arrow means sell. Just make sure that you have 2 sets of signals. Good risk limitation, bad risk limitation, bad risk limitation, good risk limitation. Consider that shaded gray area. All right. This is where you buy and you've got good risk limitation, when you buy and you've got poor risk limitation, when you sell and you've got poor risk limitation, when you sell and you've got good risk limitation. That's a strict minimum. I personally have like 10 layers in here. That's not necessarily something you need to replicate if you do without the indicator, but the bare minimum is at least 4 layers. All right, and try to add other layers as you get better at trading. But experience will guide you through this. All right, will get you better at this thing. If you want to do without momentum, this is how you'll be doing this. All right, first learn your patterns, then make the decision process according to risk management, which means don't go easy. This is where you got to be precise. All right. Regarding the trend channel way of analyzing, all right, this is how it is. If you can, and if you're good at trend channel plotting, but this is really the step 1. You need to be good at trend channel plotting. You need to do it naturally, efficiently, and without subjective analysis. As you've been plotting this, there is one really important part of my strategy that we haven't been talking about, which is breakout targets. So you need to, you know the breakout target rules, right? When you see a breakout, you need to highlight the breakout area. All right, highlight the breakout area, which, for example, in here we got a breakout. You take the highest, the level we broke, you take the lowest candle close, all right, and you double it to the upside. That will give you a breakout target in here, right? This is an additional risk management layer that can add to momentum, all right? But, all right, I'm not going to really down this road in here. Most likely today was about trend channel plotting without, or at least limiting the subjectivity to its minimum. If you're good at it, then on the future, add the breakout, but just one step at a time. And don't forget that in terms of risk management, at least minimum 4 layers. And you've got something that is pretty close from my strategy, using absolutely free tools, but still using the logic of my strategy and stuff like that. So you'll simply be able to do the same thing as I do with different tools, but the same psychology behind it. So it's as good as it is, just like I said. It introduces a little bit more risk, but risks that you can totally manage if you work a little bit on this, like work around plotting fucking channels, learn around momentums and stuff like that, and you could definitely do it without my tools. All right? So I hope it was educational today. That's a question you guys have been raising for quite some time, so I hope I've been answering this one today. At least I did the best I could. I'll see you again later. I'm still waiting for volatility to show up into Wall Street to eventually restore the daily educational trading podcasts. But in the meantime, market is dangerous. I'd rather like you guys to stop trading until we've got a clear resolution of whatever the fuck is going to happen in a nearby area. Are we going for weekly bullish breakouts and possibly a market bubble, or are we going for a market excess in here in a ranging context, which means back to the ranging support, and as the ranges mature, likely bearish breakouts afterwards. So that's the important question for the following weeks. Days and weeks. Until I get the answer, I'd rather like to stay off market, but that doesn't prevent me from doing educational content. This is what we've done today. I hope you like it. There's obviously going to be another one next week, possibly and probably on Wednesday as well. I wish you guys a good week, and see you later.